Well, hello, traders and investors. My name is Roger Scott, and today is March 8th. It's the first day of the second week of March, the first trading week of the second week of March. To give you guys a little perspective, believe it or not, but we're just a week away, about a week, maybe 6 days away from this whole COVID lockdown started. I think, if I'm correct, it was somewhere around March 13th, March 14th, when we all went home for the day and then never went back to work. Can you imagine? It's been a year since this god-darned lockdown. I mean, it's been crazy to think about it. It's like a big black hole. But here we are, it's a year later, and we're finally starting to come out of it just a bit, as you will see by the stocks that I'm looking at right now. But the market is down. The Nasdaq is down 179 points, and we just got the stimulus bill. So we're seeing a down market on really positive news. And I'll go into the whole thing, but I want to show you something right now. This is really important. And I hate to say I told you so, but boy, did I tell you so, and I told you so many times, it's ridiculous. If I got $1 for every time I told you what I'm about to go through right now, I'd probably be a rich man. I am a rich man. Anyhow, let's go through this. This is momentum levels, folks, and this is what you need to focus on. This is the number of stocks in the Nasdaq trading above the 200-day moving average. Now, while everything was peachy and beautiful and rosy, I told you guys this market is stretched out. I gave you the whole rubber band example. And now momentum levels, the number of stocks out of the 100 stocks in the Nasdaq 100, it was at 90 percentile. Now it's 70% of stocks are trading above the 200-day moving average. I believe we'll go down to a minimum of 50th percentile, which will put the Nasdaq 100, which is what we're looking at, and it's down 183 points, and it's down 1.46% right now, about an hour and 22 minutes before the opening bell. But I think we're going to hit the 200-day moving average or come close to the 200-day moving average before we shake out, simply for the fact the momentum levels are just too high. And when you can see here, let me show you. Look across. The last time we were here were 11 years ago. 11 years ago. And afterwards, we sold off to the 30th percentile, which is where I think we're going to go, about 40th or 30th percentile, the average drop after going to these type of levels. It's just, it happened every time in the last 20 years. Why should this time be any different? Now, if you look at the number of stocks trading below the 50-day moving average, we're getting close to the bottom. But I want to show you something, because the bottom is very interesting here. It's a perspective thing. So when you look at the bottom, we're right now at 30th percentile. I think this thing is going to go down to the 20th, maybe to the 10th percentile, and really bottom out, because we've been at this high level for quite some time. And whenever we get there, we typically bottom out below this level. We typically go, as you could see here, to the 20th level, and that's what I think we'll do. We'll bottom out to the 20th level, and when it comes to the number of stocks trading above the 200-day moving average, will bottom out at the 50th, 40th level, which will put the Nasdaq lower. It'll put it closer to the 200-day moving average. And remember, we've had good news today. Over the weekend, we've had the stimulus, which we'll talk about in a minute. That stimulus should cause the market to rally. So we're seeing nasty downside pressure. Nasdaq down over 1%, 1.5% on really positive news. And that, folks, is not beautiful. That's terrible. Now, in terms of what we can expect this week, and by the way, last week, just to give you some perspective, I don't know if we can go, yeah, we could go down there. Let me show you something. The employment situation last week, last Friday, was actually really good. I don't know why I can't see it, but I can't. That's weird. Usually I could see the report, but I guess not this week. Let's go to this week. Let's go to the current week. All right, this week we've got, but anyway, what I wanted to show you was last week's unemployment numbers was really positive. It shows that there was a lot more people applying for jobs, and the number was actually positive. It was better than expected, and the market rallied on that number. But again, this week, today, with the stimulus bill coming out over the weekend, the market's down, and it's down quite a bit, down 1.41 right now. So that's, when markets are down on positive news, that's not bullish. Now, again, the big reports for this week is going to be jobless claims, which were making strides last week. I think the average is somewhere around 750,000. It'd be great. Here, 745,000. It'd be great if we can break 700,000 and finally break down. Not sure if that's going to happen, but By the end of this week, we're going to have a good idea of how strong the inflationary pressure is, because we're going to get the consumer price index, and we're going to also get the producer's price index. So we'll get a good chance to see what consumers are paying and what producers are paying. So it'll be very interesting to get a gauge of inflationary pressure, because with the long-term rates going higher, there's a good chance that we're going to see some inflation. We're also going to get consumer sentiment, which is not a big report on itself, but it gives us a good understanding of where retail sales is going, and retail sales make up 2/3 of the economy, 2/3 of the GDP. So the consumer sentiment report is going to be a big one. The CPI is going to be a big one. And the PPI is going to be a big one, and obviously jobless claims is going to be a big one. I'm not expecting anything big on the petroleum reports, as you will see right now when I talk about the global news and why. So global shares were mixed Monday after the passage of the 1.9 billion U.S. stimulus package. And again, they weren't really mixed. They're down in the U.S. Heavy selling of shares in tech companies helped drag benchmark lower in Japan, South Korea, and in the U.S., as you could see here. Look at that, down 1.5%. Not good, not pretty. Beijing data released Saturday showed Chinese exports surged 60.6% over the year earlier in the first 2 months of 2021. That's amazing. As factories reopen and global demand gradually recovered. We need that, folks. If China can recover, it'll export more, and if it can export more, global economy will begin increasing. Remember what happened last March, April, May? We couldn't get any parts from Amazon. Well, that's all China. All those things are made in China. The huge increase reflects a rebound from the plunge in manufacturing and exports in early 2020 at the height of Chinese COVID outbreak. Absolutely. Couldn't have said it better myself. U.S. economy aid package passed narrowly by the Senate on Saturday. You would know it if you were looking at the stock market right now, down 1.55%. Provides direct payments of up to $1,400 for most Americans and extends emergency unemployment benefits. $1,400 to Americans. Summer's coming up. Retail sales, fun, amusement parks are opening up. Things are opening back up. Look for people to start spending money. Video games, oh yeah, video games, amusement parks, movie theaters, entertainment. Not so sure about movie theaters, but look for the market to reflect not the stay-at-home environment, but the going out, the back to normality environment. I don't know if that word means a lot these days, normality, but for lack of a better word, that's what I'm talking about. Rising oil prices are part of that picture. Yes, they are, and oil prices are moving higher, but you've got to still be very, very selective, and I advise you to only look at companies that are trading at or above last February and March breakdown levels. Very, very important. So check February and March of 2020 levels before you go into any stock, any rebound stock, and make sure it's trading at or above those levels. The devastating winter freeze that hit Texas, oh yeah, and other parts of the southern United States last month knocked out production of roughly 4 million barrels per day, which we actually need because we had so much supply. And oil price climbed above $60 a barrel, but don't hold your breath just yet. Last week, with oil prices rising, some observers were expecting the OPEC cartel and its allies to lift more restrictions and let the oil flow more freely. But OPEC agreed to leave most restrictions in place despite growing demand. They want to see demand grow further. I remember when oil was below $50 a barrel in the summer, last summer and before that, but it looks like things are starting to make a comeback, which I'm really, really happy about. My biggest concern is the Nasdaq 100. I think it's going to wash out and hit the 200-day moving average. Now, in terms of the S&P 500, it's going to take it with us. All those stocks are with it. So expect, let me go to the 50-day line on this one. Let me show you this here. So here you could see the candlesticks, and you could see the S&P's barely breaking the 50-day. It's actually still sitting at the 50-day moving average. And it's just now like right here. Well, the Nasdaq is like all the way up here. Here, you could let me show you the Nasdaq 100. I mean, talk about being in the toilet right now. Whew, look at that. This thing is halfway down, more than halfway down between the 50-day and the 200-day line. Let me see if I could change the color. I can't even change the color of this thing. Let me see here. Yeah, here we go. Make it a little more dramatic, make it red for you. But the bottom line is, you could see here, the Nasdaq 100, this is at 320 and this is at 280. So say 300, and we're right at 300, 308 right now, 304 we're going to open up. So we're right halfway in, where if you look at the Russell, oh yeah, if you look at the small cap stocks, they're barely breaking the 50-day line, and look at where the 200-day line is. And if you look at the Dow, so it's not all bad. It's the Dow's barely down. I mean, look at this. I gotta remove this thing. The Dow is like still trading squarely above the 50-day line. So it's not broad-based. It's mostly tech, and that's why I want to focus on 3 stocks that are unrelated to tech. They're actually all related to us opening the door and getting out into the wide open and into the public, and getting out into the world again. First company, L Brands. It's making an all-time swing high 3 days ago, last week, while the Nasdaq was dropping. It went 3 days down, and now it's ready to come back up. I like this level right here, right around the 56 level. You could put a stop loss at the 52 level. And if you look at a 2-year level, this is February of last year. Look where we're at now. Talk about breaking higher, right? Look at this breakout right here. Look at that. We called this thing from 24 all the way to 56, and I'm still bullish on it. Next one, Deere & Company, industrial, basic material stocks. Let's look at where the stock was. Look at where the stock was February last year, way above it. And as you can see here, made a swing high last week, beginning of last week, the first day of March, and now it is coming back up. It had that 3 down days. Now it's coming up. Nice short-term pullback. You could buy it around 352, put a stop loss around 330. And finally, SeaWorld. I went to the zoo yesterday with my family. It was packed, and I mean packed. If you look at a 2-year chart, look at where we were in February of last year, and look at where we're at now. Anytime I look at something, I want to make sure it took out the February high. Like, for example, if you look at energy prices, let me show you this. If you look at energy prices, look at where we were last February, and look at where we are right now. We're still a little below it. So I'm cautious on energy. Some energy stocks have gotten out, so you got to look at them individually. But the bottom line is, you got to be cautious. Large cap tech is not where you want to be right now. You want to be in retail, basic material, industrial stocks, stocks that are screaming, we want to go back out, stocks that benefit an economy when the economy is open, stocks that were just on the crapper a year ago. Those are the stocks that you want right now. Disney, L Brands, SeaWorld, that's where the money is right now. So again, let me give you these 3 stocks, and let me show you the buy level here as well. And again, made an all-time high last week. They all made all-time highs on the first, and then for the remainder of the week last week, they sold off, and then Friday they rallied. And again, I think it's ready to rally more. Buying it around $49, $50 level, stop loss at the $43 level. And again, these stocks are completely bucking that large cap Nasdaq trend, and I think they'll go higher. Now, if the Nasdaq really cools off, if it continues breaking, it's going to impact the S&P 500, and it will have some impact on the broad market. But as of right now, this correction seems to be fairly focused on the relationship between interest rates and large cap tech. And interest rates are telling us that large cap tech is overbought slightly. And as you could see here, the bond market continues breaking lower, which means long-term rate, this is the 10-year or 20-year plus. The long-term bonds are moving higher. Interest rates and the bond market moves lower, interest rates move higher. They're inverse. And the interest rates are like at 1.5 something percent right now. They're going to go up to about 2.5% by the end of this year, and that may cause the QQQs to offset a little bit, because there's they yield the most in comparison to bonds, and if bond yields go higher, we have to have higher expectations from tech stocks, which we are not getting right now. So that's causing price level to decline. In other words, they are too expensive based on the current bond market yield. But the rest of the market is stable. So look at L Brands. Look at this trend. It's beautiful. Very small pullback, if any. Look at Deere. Look at this. All-time highs. And look at SeaWorld. SEAS. And again, folks, Be cautious this week. We're going to have a good idea of inflationary pressure. We're going to have both the consumer price index, the producer's price index. Unemployment levels are starting to be a little bit better than expected, a little positive. Jobless claims are starting to decline. We're starting to get out of this, and COVID vaccines are starting to kick in, which is huge. But don't hold your breath yet. We need to see a shakeout on the Nasdaq, and I don't think we're there yet, especially when we're seeing such negative numbers or negative opening, down 1.5% on the stimulus bill. That's not happiness. Now, before you guys go, I've got something important for you, really important. Have you noticed how stocks fall and are quickly written off by retail traders, and then randomly, out of nowhere, they skyrocket? That's all thanks to modern day kingmakers. That's right, kingmakers. But who are these kingmakers? And how do you get in on the action before they send the stock soaring? Right? Don't you want to know about these kingmakers and how you get in the action before they send the stock soaring? I've got good news for you. Stock market expert Adam Sarhan, he has all the answers for you. And he's finally ready to reveal how you could take advantage of massive moves by the kingmakers. You've got to learn all about this. All you've got to do is click on the link below to see what this renowned trader and Forbes contributor has to say. You can't afford to miss this. Kingmakers, how they send stocks soaring, stocks that are written off by retail traders randomly out of nowhere, they skyrocket. You've got to check this out. Follow the link below and see what Adam Sarhan, who's a Forbes contributor, has in store for you. And make sure to like this video and subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And have a great week ahead. And keep your eye on that Nasdaq. It's a roller coaster. Bye, folks. Have a good one. Take care.